and delighted to welcome you to the latest of our PRCA COVID Task Force forums. And today we're talking economics with Graeme Leach. For those of you who've joined many of these sessions, we've been, if you like, toggling between sessions that look at day-to-day practical insights for running an agency or a communication function with more macro topics. And as I say, today is very much the latter. So, as I say, delighted to be joined by Graeme Leach, a former long-standing chief economist and director of policy at the Institute of Directors. Graeme, welcome. We're delighted to have you on.
Thank you, Rod. Good to be on.
So just for those who are watching, can you give us a little bit of background of your journey as an economist through times in think tanks, through to the IOD, time in the city, just a little bit of background on who you are and what you've done?
Yeah, sure. Well, I started my career at a great place, what used to be called the Henley Centre for Forecasting. And they were great because they were just very innovative, and we just looked at the future in a host of different ways. It wasn't classical forecasting in kind of modelling sense, and took that kind of worldview about how you look at the economy into the city jobs and into consultancy, and then ended up at the Institute of Directors, where it was a combination of economic forecasting, but also a lot of economic policy analysis as well, and campaigning on issues as well. So got a real feel there for media and what works and what doesn't work in a media context. And then left there to go to an institute which is not maybe as well known, the Legatum Institute, which is a global institute which looks at the sources of prosperity around the globe. And then just to fast forward, I was very ill. I had a kind of life-changing experience, shall we say, on the health one, and kind of went out on my own for health reasons initially, but stayed that way. And so now I've got two hats. I'm my own company, Macronomics, where I do a lot of economic consulting, and in combination with a great guy, David Smith at Global Futures and Foresight, I do futures consulting. So I'm very fortunate in what I do. I really enjoy it.
Brilliant. So before we dig into that, just on the futures consulting, because obviously, anyone who has a crystal ball with any degree of accuracy is in high demand. Have you been having any conversations with our community, the world of marketing, communications, public relations, and what sort of conversations have you been having?
Yeah, I have actually had one this morning, and it's very much thinking about, okay, what's the world going to be like post-COVID? How does it change? It's the same? How does it differ? And what are the short-term effects? What are the long-term enduring effects? And that opens up a host of possibilities around the future and thought leadership. And so, yeah, we're talking to a number of PR agencies and companies about what we could do for their clients in the post-COVID world. So yeah, it's exciting. It's very interesting. It's fascinating. And it really spans the gauntlet. I mean, we're talking about technology and whether there'll be greater agility in a post-COVID world. Believe it or not, we've just finished a project as well on the future of religion in a post-COVID world.
Of course you have.
So that's slightly lateral thinking, has to be said, but interesting.
Very good. And presumably those conversations linked very much to, the demand we were under before, but even more now, about proving impact, proving this business value.
Absolutely, yes. I mean, it's got to have a bottom line implication. That may not be an immediate bottom line implication, but you've got to show the connection there. It's not thought leadership for thought leadership's sake. It's thought leadership with a purpose, and ultimately, for the client to use it for their own purposes as well internally, and to think about the future of their market. So it opens up opportunities for clients, but it also should be something that the client isn't just using for thought leadership. They should be using it for their own business purposes and strategy.
Of course, absolutely. So let's dig into the detail and see what your crystal ball reveals to our audience today. And obviously you've done 3 reports recently, respectively, looking at economic scenarios for the UK, geopolitics, and the long-term legacy. So we're going to talk through some of the findings from those in the round. Yeah. Looking at your economic prospects paper, obviously a huge amount hinges on the impact of epidemiology, of how COVID and the coronavirus evolve epidemiologically. Can you just talk us through some of that? Because obviously with so many variables, understanding that piece and how it drives potential economic trajectories would be really interesting.
Yeah, great. Very happy to. Might be a good moment actually just to share screen and then just pull up some PowerPoints which kind of can illustrate the discussion. And
that'll be good.
So if we just hold 1 second.
There we go. You can see that perfectly.
Good. Right. Okay. Right. Okay. Now, the first chart here shows 5 scenarios, and the key thing about our report, Coronomics, on economic scenarios for 2020-21, the key thing is that they have to be epidemiologically driven. So then the first question is to go, what's the epidemiological scenario? And well, unfortunately, if you think economists hedge their bets, well, the epidemiologists aren't certain at all. And so you end up with a scenario where there's everything from a very fast lifting of the lockdown in the third quarter of this year, and in a miraculous sense, you could get a resumption in output and return to what we lost within 1 quarter by the end of the third quarter. That's what we call the Super V scenario. That's based on a sharp bounce back, a sharp lifting of the lockdown and removal of social distancing, and that gives us a bounce back in output which occurs, and the lost output is made up by the end of the third quarter. The V-shaped scenario, not what I would call the miraculous recovery, which is the Super V. The V-shaped is a miraculous, well, it's not miraculous, sorry, it's a full recovery by the end of the year. Now that is something more along the lines of what the Bank of England and the OBR are forecasting, and that's perfectly possible. Either Super V or V are entirely possible if one looks at history. If you look at the Hong Kong flu of 68, 69, or into 70 in the UK, and if you look at the Asian flu in 57, 58, and indeed some would argue with regard to the Spanish flu in 1919 as well, maybe in the UK, less in the US. So it's difficult to be sure there, but the key thing is that history teaches that there can be a very sharp bounce back. It also cautions that the deeper the downturn and the longer it lasts, then obviously the greater the problems become. And so if it's not a Super V or a V, what else could it be? Well, it's more likely to be some sort of U-shaped scenario then, where things don't bounce back, where you do get a recovery in the lost output, but the turnaround in the labour market and unemployment and employment, that takes longer. And so the output we had in the first quarter of this year, is that level isn't regained until maybe 2022, 2023 even. That's a pretty difficult scenario. Worse than that is what we call a W. That is where we get a bounce back in the economy now over the third quarter and into the fourth quarter, and then we get hit by a second pandemic wave. And that leads to greater lockdown, maybe not to the scale that we've seen already, but certainly a significant reversal in policy. And then a worst case scenario is where you have something along the lines of a second wave in the autumn, and then even maybe a third wave in next year as well. And that just means that the economy can't recover lost output for years and years and years. It's a very unpleasant scenario. It's the most unpleasant scenario as an economist I've ever prescribed. I'm not saying I believe it'll happen, but for the first time in our economic history, you do have to consider scenarios. So we've got 2 contrasts here. I would call the V or the Super V actually the roaring 20s, and we'll talk later on why I think there's an upward inflection in growth coming, and would have been coming regardless of COVID, and could still come in the wake of COVID because of its impact on technology. Right through from the roaring 20s through to what might be described as a 1930s sustained depression scenario. So wide variation without any shadow of a doubt, but that's purely and simply because we just do not know what the epidemiology will bring over the coming months and years. Very difficult. But what we've tried to do here is really clearly spell out what the economic consequences are of the different epidemiological outcomes. The approach we take is that the story is more important than the numbers. It's narrative forecasting. Yes, the numbers are important, but it's much more important to understand the story, what lies behind. So if you look at the report, there's differences in the R number, in levels of herd immunity, and how that feeds through into lockdown and social distancing, and how that then feeds through into the economy. These all have to be linked together in order to really truly understand which of the scenarios might be coming to pass. And that's how we want to help clients, is actually understand that so they can prepare and plan for the future.
Can I just ask a question on the first of those? Because I was kind of surprised that, and I know, you say everything is possible, but the idea of the Super V scenario, which is effectively by the end of the year, we are back to the same levels of economic output as we started the year. You say that's possible. This may be too simple a question, but what are the preconditions that we would need to see for the UK economy to be back at the end of the year where it was at the beginning?
Okay, well, the Super V is miraculous. It's a recovery in lost output by the end of September, the end of Q3. That is miraculous. That would really require all the social distancing measures and lockdown measures to have been lifted really by the end of July, early August. That is probably a big ask. The full recovery foresees output recovered by the end of this year. So instead of end of Q3, end of Q4. And that would really require all the lockdown measures to have been lifted and social distancing measures by the end of Q3. So you then got a free run in Q4, and Q4 just soars. It's already going fast in Q3, but then with a complete elimination of lockdown and distancing measures by the end of Q3, then you could see miraculous recovery by the end of Q4. This can happen. My caution is that when you've had the bounce back in one quarter before, then it's tended to be because it's a very small dip in the first place. For example, in the Asian flu, the government increased medical welfare payments and shut a few coal mines, and that was about the extent of it. A little bit different this time around. In 1970, the lockdown, well, there wasn't one. The social distancing, well, there weren't any. And all you had was some kind of caution, and then within a quarter, it was all made up. And you ask some people, and they can't even remember that there was a pandemic issue in those periods. So very different to now. And so it's unlikely you would get the Super V. I still think V is possible, still think it is. My wife says I'm a born optimist, but I think there's sound economic reasons that as you lift the lockdown, that you will get a situation where supply creates its own demand, in the sense that companies will begin to increase output, the confidence will build, both in businesses and by consumers. Fear of unemployment would decline, and you could have a sharp bounce back. If you were really going to force me, I'd probably be closer to the U than a V, because of precautionary behavior by consumers, and because companies are just going to be a little bit wary about the future as well. So until they're confident there won't be a second or third wave. So I think to get the Super V, you'd need strong evidence of herd immunity and a vaccine. And certainly to get the V-shaped scenario, you need pretty much the elimination of all the current measures by the end of the third quarter, so you can have a complete recovery in the economy by the end of the fourth quarter. But they're not impossible. They may seem a distant prospect at the moment, but they are. Things can change. Things changed very quickly when we went into lockdown. And if you lift the lockdown relatively quickly, things can change very quickly on the other side as well. Of course, the risk is that if you don't have the elimination of the lockdown measures, and you do have upticks, and you do have a second or third wave, then it just, one thing builds on another then, and suddenly the end of furloughing risks second wave of unemployment, because companies don't have the confidence to retain staff. So we're walking a tight ridge here. There's a very narrow ridge to the top, on the tops of the Matterhorn, and you can get up there, you can reach the summit, but there's danger on either side as you progress.
Absolutely. And to that point about, the potential for sort of hidden unemployment, there's been a lot of debate in the media and amongst economists about whether we're in a sort of economic phony war, in that as long as the furlough scheme and equivalent schemes around the world continue, that we're actually disguising what the real economy is doing underneath. Have you got any data or any insight as to how phony a war we are in, and whether the furlough scheme truly is disguising, an inevitable cliff edge once it's removed?
Well, I think it goes back to what I was saying before, actually, Rod, that you need confidence there. You need the confidence of consumers to be spending and not saving. You need that bounce back in spending behavior. That's not to say that we get wild conspicuous consumption and queues outside shops because we haven't seen it, akin to the New Year's sales. But it is that consumers are confident enough to start spending money, maybe not all of what they've put aside. But you need that consumer confidence, and you need business confidence as well, that markets are coming back and they can see the future. Because otherwise, then anticipating the end of the furlough and without any confidence of the future means that inevitably a large proportion of those 9 million jobs could be under threat. If you combine that with obviously more supply side changes along the line as well, that suddenly companies have discovered new ways of operating, in which they may continue from after the lockdown, then that is a threat. So we need confidence. Confidence is absolutely fundamental here. I know that sounds a bit kind of intangible, but it's one of those things which will actually save the day or won't. And if we don't have confidence, then the phony world will turn into a second wave of unemployment. And then, of course, business and consumer confidence is going to take a second leg down as well. So we need a rapid lifting of the lockdown, which demonstrates the economy can recover, a return of business and consumer confidence, and by the year end things will look a lot different than they do now. But the caution is, of course, that that assumes some sort of straightforward progression in the lifting of the lockdown and social distancing, and in reversals there will directly impact confidence.
And presumably, we're almost back in Harold Macmillan, I think it was Macmillan territory, of the only thing we have to fear is fear itself. Because on the one hand, you have people wanting to go out and spend, but then they're also scared of the loss of their employment or a reduction in their income. So you're in this sort of cleft stick, whereby the very thing that you need, which is people loosening the purse strings, is potentially quashed by the fear. So it could almost be a vicious circle or a virtuous cycle, depending on whether, savings ratios are obviously higher than they've been potentially in living memory, certainly data from the States this morning. So I suppose that vicious circle versus virtuous cycle is the nub of what you're talking about here.
Yeah, absolutely right. I mean, the US savings ratio was 7% before the lockdown, 13% first month of the lockdown, 33% in the second month of the lockdown. Now, even allowing for a lot of precautionary behavior by consumers, that still is a potential wall of money that can be spent. UK numbers aren't quite the same, but there is potential there. I think I would also add, beyond confidence as well, other factors. One is that as you lift the lockdown, then a lot of the stimulus effects will only now come through, because, the monetary and fiscal stimulus has been immense. the fiscal stimulus, obviously, in terms of the furlough and various relief packages, but more importantly at the present time is actually the monetary stimulus which is going on. And it is truly astonishing, actually. Again, if you look at the UK, the broad money supply growth in the UK is now just under 10%. It's at 9%, heading for 10%. Now, that number has never been achieved since the onset of QE. When the Bank of England, it's so long ago, they've forgotten they said it, but the Bank of England introduced QE, and he said its target rate of growth for the money supply to show that it worked, QE worked, would be 6 to 9%. Now, it's trundled along below 6% for years and years and years, been 6 to 7% in recent years. It's only in the past 2 or 3 months that it's accelerated to 9%. In the US, the money supply is growing now at its fastest rate in peacetime history, nearly 20%. So there is a huge monetary stimulus working its way through the economy, and that takes time. And so one of the hopeful signs here is that as you lift the lockdown and the economy gets a boost from the supply side because the chains are removed, then at the same time, this following wind comes in, as if to use the stretch any analogies or metaphors here, and really further boosts the economy. And that is a massive monetary boost. What it also means, actually, is that if we don't get the boost in output and demand in the way of that monetary stimulus, then we'll get something called inflation as well. So one of the real paradoxes here is that a situation which led to one of the deepest downturns could see the resurrection of inflation. Sorry, what you were going to say?
We'll come back to that because I think that's a fascinating, and frankly, I was surprised when we discussed that yesterday. There's a great question here from Siobhan, which is, what are your thoughts and predictions about the changing nature of employment? In other words, will it be driven exclusively by profit and sustainable profit, or will employers be influenced by ESG as well? For example, she says, will businesses with no confidence to retain staff full time adjust their working patterns? Will they be willing to employ people around the world rather than just in proximity to the HQ with home working? So I guess a few questions there, but essentially around the changing nature of employment in a world of home working and ESG.
Yeah. Great question. Could spend the rest of the week answering it, but I'll do my best in a few moments. I mean, let's just rewind back to pre-pandemic. You had employment at record high, unemployment at record lows, and you had a progressive structural shift in the labour market as well, due to factors such as technology and how that was automating many areas and many occupations further up the occupational scale than before. Now, even in the most optimistic scenario, on the Super V scenario, unemployment would still end the year probably a little bit higher than it was before the pandemic. V probably, so that would be maybe 4 or 5%, a V maybe 5.5%. And so the labour market will be more fluid, and what happened in the great financial crisis was that in this fluid labour market, it performed more flexibly than it had done hitherto. And so we had wage flexibility, for example, in the wake of the financial crisis on a scale that we hadn't seen before in previous post-war downturns. And so I think there will be a lot more flexibility. Employer power relative to employees will shift, but at the same time as well, companies are going to be very wary because if their competitors are looking optimistic about the future and they're not laying people off, then it may be a mistake to lay off people yourself, because you may not be able to recruit them when the market turns. So I'm actually quite optimistic for the labour market under the U and V scenarios. And I think what will also happen then, and it leads into more of the structural effects of COVID-19, is some really big things begin to happen as well. Because one is that a new agility, discovery of new agile ways of working, new business models, then yes, that means that potentially they could source employment from overseas. But also in this new fluid environment, it can mean that domestic employment costs and labour costs are not as high as well. And so you can operate domestically. And ultimately, this has huge implications for the manufacturing sector, because we could see reshoring, onshoring, 3D additive manufacturing, a manufacturing renaissance. If you move into that automated 3D world, where labour cost becomes less significant, full stop anyway. And there you've got one of these paradoxes of globalization, that technology could ultimately, as a result of COVID, maybe accelerate onshoring and reshoring, because people are thinking about their supply lines and all sorts of factors like that. But it also hastens something which was going to happen anyway because of technology. COVID just gives it some rocket boosters.
Got it. And just, I'm always interested by the way in which, and this is not a criticism of your craft, but the way in which economics has a tendency to use phrases like labour market flexibility and agility and pay agility as ways of talking about people being given less work for lower wages with less job security. So again, there's no criticism of the language. I'm just interested whether, even in your most optimistic scenario, that's good for the economy, but is it good for people? Because I think some of the things, if you debug them into non-economic language, may end up being less positive for individual human beings than for the economy as a whole.
I think the key thing here, Rod, you're right, and the gig economy can mean different things to many different people. So you're right to kind of highlight that. I think what I'm trying to focus on really is, certainly from a technology standpoint, is that what can it do to raise productivity? Because ultimately, in the long term, productivity growth is what brings real income growth. That's our growth in our income over and above inflation. Productivity does that. The economy is more productive, and that gets shared out, hopefully. Now, there are distribution issues attached to that, but what you need in the first place, at least, is the technology enhanced productivity. So to the extent that COVID accelerates technology and productivity growth, then to that extent, it should improve incomes. But I accept there are distribution issues there, which may or may not need to be addressed. But in the long term, productivity is what drives our standard of living. It's what means that we are so much better than our parents' or grandparents' generation in terms of our standard of living on average. So it's a good thing from a technology perspective. I guess it's less of a good thing if it's something which involves maybe a much higher level of unemployment than before and lower levels of employment, which means that companies face one, weaker market, so they're not as profitable, so they can't pay as much, and also they have an incentive maybe to pay less because there's a plentiful supply of labour. And if the domestic labour supply isn't there, and it's a relatively unskilled, or it may be skilled, then they may want to source from overseas as well. But if we get the technology right in the wake of COVID, then all the other stuff falls into place.
Got it. I want to pivot in a second to the international piece, but just we obviously can't go through a discussion about economics without mentioning the B word, Brexit, which of course, has been wiped from the front pages and everybody's lips quite remarkably for a good 6 months now. I'm trying to keep politics out of the question, which is always difficult. As an economist, what would your analysis be of the seemingly likely scenario that we're heading for no deal effectively, and therefore falling off a cliff edge? What are your prospects for the UK and Europe of that scenario?
Yeah, I mean, well, I'm not sure I'd agree with it falling off a cliff edge, but I don't want to reignite a Brexit debate in the middle of COVID. But I think one of the key things here, and the most amazing thing, Rod, which you alluded to really, is that Brexit has been the issue which dominated our every waking moment for 2 or 3 years has disappeared. And in the introduction to the report, the Coronomics report we've written, we actually have a box which says in red writing, explaining why Brexit isn't mentioned. And the reason Brexit isn't mentioned in the report is because the orders of magnitude just of COVID just swamp it. When you're talking 10, 15, 20, 25, 30, 35% on some estimates, changes in output quarter on quarter, then something which might have led to a 0.5% or 1% change in output from Brexit just isn't a material consideration. So it doesn't change any of these scenarios at all, Brexit, regardless of deal, no deal here. I actually think there will be some form of deal. I think this will be the 11th hour, but it will happen. And I think, but even if it doesn't, then World Trade Organization rules are not the end of the world. And there are things we can do as well to alleviate the pain on, say, car manufacturers who are very, very worried about facing a 10% tariff. Well, outside of EU rules and on enterprise support, you would be able to provide direct relief there in some form, whether it be tax relief or whatever. So there are offsets here, which and ultimately, World Trade Organization rules, we must remember that they benefit consumers and producers. At the moment, we have been inside the EU's protectionist wall, which means consumers and intermediate producers don't source at world levels. They don't pay world prices. They pay world prices plus EU tariff levels. And so consumers will be a lot better off post, even with a no deal WTO shift at the end of the year. And intermediate producers will be as well. I accept there are issues for some producers exporting into the EU. But again, that there may be offsets there. And I think increasingly, if you look at the city, the city wants to be outside of any EU rules-based agreement. So I remain optimistic about the outcome there.
You heard it here first. Brexit is irrelevant, and WTO rules are a good thing. I didn't expect you to say that, but that's probably my political bias coming.
I should say I would rather have unilateral free trade, where we had zero tariffs on imports from everywhere in the world. Economists don't agree with many things, but one thing they really do agree on is the benefits of free trade. And it's one of comparative advantage goes back to David Ricardo in the 19th century, but it basically shows that the economy and our economic welfare is maximized in an environment of zero tariffs. And so even if people put tariffs on us, we shouldn't put tariffs on them.
Got it. So that's a nice bridge onto the international piece. So obviously you'll have seen all the coverage today about the US president buying up the entire world's stocks of remdesivir for the next 3 months from Gilead, which I of course remembered was actually the dystopian world in A Handmaid's Tale, but that's a separate issue. I'm just very interested. There's been a lot of debate this morning, some of it politicized, about the idea, people saying, well, here we go. We're going to stake our trading future with no deal on someone who patently has said he will put America first and has now shown it by buying up all stocks of a drug that makes the experience of COVID potentially less impactful. What are your thoughts on the potential for a maintenance or increase in free trade versus a return to isolationism and protectionism? Again, I know a big question, but I ask it purposefully.
No, it's a great question, Rod. But economic nationalism has been around for a long time. Trump's just intensified it with his maniac tariff policies. doesn't understand economics, doesn't understand benefits of free trade, doesn't understand that even China undercutting American companies is good for American consumers. It's estimated that the China price effect and outsourcing to China has given the average American family an increase in income of around $10,000 per annum.
Wow.
That is the benefit of free trade for them. It's hidden. You can all, what you see is when you see the factory gate shut and production move to China, that is a very visible, concentrated focus. You can relate to that. You see the pain. What you don't see is a diffuse gain that all those households across the country pay a little bit less for this or a little bit less for that or whatever it might be. And that effect is diffuse, and you can't point a camera at it and take a picture of it. It's very difficult to understand. It's very difficult to measure. So that Trump and nationalism was always there. The worse the economic scenario, undoubtedly, the more we move into kind of Smoot-Hawley tariffs of 1930s, protectionism, beggar thy neighbour policies. I'm really fearful of that economic nationalism. There is no doubt that that could occur, but it may not. Let's say there was a change in leadership at the top. Now, I'm not saying that I vote Biden, but for all his views, and I would disagree myself with some of his views, but I think he would actually be more inclined to adopt, to maintain the US's previous position in support of a rules-based international order. I think that would be a clear shift. So it doesn't have to be this way. If we get a recovery, a super V recovery, and we get a change in leadership in the US, then, and we get a kind of global stirring where people say, we're not going to do this again. We need to create kind of global organizations to address this. You could see how deglobalization wouldn't be as great as under a kind of Trump scenario where none of that is possible. Now, I'm not saying support the WHO. The WHO has got a lot of failings, but it doesn't necessarily mean if Trump wasn't there that the US would be averse to new international organizations which could coordinate measures in the future. So I think we can be very nervous about what plays out here, but it does depend on the economic scenario, and that depends on the epidemiological scenario. I think a V or super V bounce back means that the existing changes in globalization would continue. For example, yes, there's been a slowdown in FDI in the wake of the great financial crisis, but it's still continued. Global trade, again, growth slowed in the wake of the financial crisis, but still grew significantly. It's only this year that it really falls sharply, but that's just as much a cyclical as a more long-term structural fact. So if we get a cyclical bounce back, what we're talking about here is structural. These are the structural changes. And if you look at the numbers, whether it's trade, whether it's FDI, whether it's travel and tourism numbers, then yes, they're adversely impacted in the short term, but there's no actual reason why they should be unduly affected under a V or even a U scenario. Yes, I think they would come under intense pressure under the kind of W or L-shaped scenarios, but those are by no means guaranteed. I think the others are more likely. So we're in this, again, we're back to the Matterhorn Ridge here, where we can get to the summit. It's the ridge has narrowed, but continued globalization remains a possibility. With my one caveat, that one of the paradoxes here could be that an acceleration in new business models and technological agility may mean that we have more onshoring and reshoring in the West. And so actually the shift in the balance of power from West to East partially returns to the West. But that's a very different form of deglobalization, because it would still facilitate massive globalization elsewhere. It would just mean that the shift in the manufacturing balance across the world reverses a little bit. It doesn't prevent a continued explosion in services growth facilitated by digital technology.
Absolutely. So you are glass half full by nature. I just wonder, without being too doom laden, presumably you do potentially wake up at 3 a.m, imagining a world where you have a W or an L scenario, the re-election of Donald Trump as US president, with all that follows in terms of international trade.
Well, I do worry about that, but I go back to even with Trump, and he has done some good things. So it's not Trump Day on my part, but I just, with a V or super V bounce back, there's just less incentive and need for him to go down that road. But so even if he's re-elected and the economic bounce back is complete by the end of this year, the beginning of next year, there's not a lot of incentive in him pushing things too far, and it probably means that he won't be too pressured either, because the shift in the balance of power isn't that great. As a result of COVID, the relative shares of world economy don't really shift that much at all. And the military gap between the US and China remains huge. So one could also see a scenario where the Chinese, probably in their own interest, a little more negotiable on the trade and tariffs fronts in the future, because one of the characteristics of the campaign in the US presidential election could be, he's already talking a lot about the Chinese virus, and there's a movement in the States to rename Corona the CCP, Chinese Communist Party virus. So
yes,
I prefer CCP than Chinese virus. But,
yeah.
Sorry.
So I just had a very interesting question from the chat, which is, when you are putting together, or before you set out your research and your predictions, do you as an economist explore your unconscious bias, particularly in terms of things that you want to happen? How do you remove bias?
Unconscious bias? You're accusing economists of that. How could you? No.
I wasn't. I was merely passing on a very good question from the floor.
Well, it's a great question. You have to. I have a tendency, which is a weakness actually, but which is that I want to investigate every last dot and tittle of an argument, and so I really do kind of dig deep, and I have to, and I feel as if I failed if I haven't covered off all the angles to come to my conclusion. So along that road, hopefully, I kind of do try and eliminate the bias. I think everybody's got a little bit of a bias, but I hopefully do. If there is a bias, my inclination towards a free market being the best allocator of resources in terms of long-term economic prosperity. That's why I'm for free trade. I'm against protectionism, and I do look at the world through that sort of lens. I also look at the world through more of an economic lens, let's say, than a political lens, when we're looking at the economics of the state versus the market. And I think that's one of the fascinating issues here, is where in a crisis where the state was definitely needed to step up to the plate, will it stand down when the crisis is over? Because one of the key things here to maximize the effects of the technological revolution underway, one of the absolute musts, is economic freedom. It's going to be those countries which facilitate economic freedom and agility, which maximize the benefits of technology and minimize the costs of demography. Because, Rod, I'm writing a book at the moment, and it's called Triple Shock. And it basically is why three once in a century events, all in one decade: COVID, technological revolution, and demographic shift, and an aging population. And COVID kind of accentuates all of them. It potentially accentuates the technology, the upward inflection in productivity and technological growth and incomes, which I believe will occur in the early 2020s, and which is going to be massive. But alongside, the legacy of COVID is to maybe increase that, accelerate it. But it also means COVID also means the legacy of the crisis is much higher levels of public debt. And so as we go into the increased burden and fiscal costs of an aging population, governments around the world go into that crisis in the future in a much weaker position than they were before the pandemic. And they were in a weak spot already. One stat just to blow your mind. The US outstanding public debt is around $21 trillion. The unfunded liabilities of the US government with regard to its future costs of an aging population, Medicare, Medicaid, etc., they're not $21 trillion, $211 trillion. We will never reach that point. There'll be draconian measures far, far before then. But it just shows you the scale of the challenges ahead for governments across the globe. And ironically, the country with the biggest collapse in working age population between now and 2050 is China, which will lose about 400 million people as a result of the enduring legacy of the one-child policy. And so there are massive fundamental shifts underway in the world economy. And really, COVID just crystallizes them, I think, in the minds of politicians.
And I know you've got some content specifically on, what you've called the knife edge ridge, just in terms of some of the longer term geopolitical considerations, which I think would be really interesting if you could move on to.
Yeah, I will. I mean, the enduring legacy, we're at a critical juncture, without doubt, in economic history. And critical junctures really do change the way the world operates. If you want to read about that, read Why Nations Fail by Darren Akameglu and James Robinson. It's a great book, and it looks at history and why signal moments such as this just mean it's a game changer. And that's very much the futures approach we take here, that COVID-19 is a game changer, and you want to be ahead of the curve here. Talked about death of austerity and debt and demography already. Alluded to the fact, of course, that on the enduring effects economically, there could be a resurrection of inflation, because the worse the public debt situation becomes in worst case scenarios, then the greater the incentive for governments just to monetize that debt. So QE sort of monetized it already, because the Bank of England bought bonds or gilts from True Pension Fund or whoever. This would be a game changer again, whereby the Bank of England would just buy direct from the government and miss out going through the secondary market. Now, we're not there yet. There's no gilt yield pressure on that at all. Quite the opposite, in fact. But there could be in the future if the government was forced into even greater public debt borrowing, and they just then decide to monetize the debt. And monetization would lead to inflation. So paradox there, worse the scenario, the greater the likelihood of inflation. Conspicuous consumption, I think there is going to be a change there. I said before that we're not going to see the kind of January sales effect again, but I think there will be a less conspicuous consumption even after a reversal in the savings ratio over the next 6 or 9 months.
And Graeme, can I just ask a question on that? Because obviously for a communications and marketing community, that's a very interesting thing I'd just like to dwell on, because obviously one of the things that many people have talked about, the experience of lockdown, is being forced to go back to thinking about their needs versus their wants.
Yeah.
And I just wonder whether, with less conspicuous consumption as a likelihood, would you as an economist therefore say that brands at the luxury end of any market are potentially facing a challenging situation because people will be focusing on sort of needs plus rather than satisfying conspicuous wants?
This is an absolutely fascinating question. If you look at economic history, there's some really strong lessons here. Even in the 1920s in the UK, it wasn't as much as it was roaring 20s in the US. It was less so in the UK. But the US was probably more adversely hit by Spanish flu. But it still bounced back, and it had the roaring 20s. And so despite people being aware of what went before only a few years, conspicuous consumption was rife in the roaring 20s. And if you look in the UK, actually, even in the 1930s, there were in a weak economic scenario, there was very strong conspicuous consumption still in certain instances. So people still want to show that they're doing a bit better than the rest. But I do think things have changed in the sense that I think there will probably be a shift towards a little bit more altruism. But I think that altruism will take a different form. I don't think it's going to take an increase in monetary philanthropy. I think it's going to be more in terms of voluntary. So it's going to be time, not money. So I think the monetary aspect of consumption, people are going to be a little bit more careful about, but I would be very surprised if people don't, those who are successful, and bear in mind that a lot of people, even in an economic downturn, are still very successful, they will still want to show their success in some form or another. But it's going to be very, in the short term, it's not going to be easy to discern, because in the short term, there'll be labour market effects and unemployment fears, which really probably apply across the income spectrum. That's the other thing which is interesting here, which does suggest maybe some form of shift. And that is that whether you're on a high income or a low income, you could have been massively impacted by the crisis. Your business, previously sound business, may no longer be so. And previously six-figure earning families may not have much of a source at all. And so that's going to be very difficult if your mates in that situation for you to then go out and buy the new car. But I suspect, people will find other ways of spending money. But I think we'll have a slow return, and it'll be a new form of conspicuous consumption. It will be kind of luxury brands associated with responsibility, something just to take the edge of kind of giving the image of greed.
So that's really interesting, because it ties back to the question earlier on about the role of ESG. And I'm fascinated by the idea of, luxury brands with a societal edge, because, we as an industry talk a huge amount about the rise of cause-related and purpose-driven marketing. So what you're saying is, from an economic viewpoint, the notion of purpose actually makes economic sense as well as it does brand sense.
I think that's correct. Yeah, I mean, a bit more precautionary saving is no bad thing in the economy. We've got a pretty low. Historically, we had a lower level, and actually, you know what? I think it's going to people are going to reassess, well, aren't they? What they need and what they don't need, because they've managed without over the course of the lockdown. But what I also think will be associated with that is not necessarily increasing savings per se, but an increase in pension saving, because people are going to say, look, I quite like this. I've enjoyed, lockdown's not been too bad. I like being at home. I've found new ways of working. Obviously, not everybody's going to say this, but I'm just highlighting one cohort. Okay, I'd like to retire a bit earlier. I've got to increase my saving in order to do that. So I think it could accelerate a shift which needed to happen economically, because the gap between the level of pension saving that is required and the level that we actually are making is far too wide. I speak from personal experience.
And actually, to that point, we've had a great question in which handily goes directly to your point about pensions, which is, why does Wall Street, and I think it's the same with all indices around the world, why does Wall Street seem to be going strong during the crisis when everything else seems to be strained? Because we've seen remarkable resilience across most of the global indices.
Yeah, I mean, it's lunacy. I mean, my only explanation for this is to allude back really to the US money supply growth. US money, the amount of money in the US economy is expanding about 20% at the moment. And just as QE fed into stock markets in the wake of the financial crisis, we're now seeing the expansion of the money supply. Its most immediate effect is just going into equity markets. It doesn't make fundamental sense at all. It doesn't make sense. So just as the market tanked with the lockdown, then turned, I'm not a stock market predictor, but if I was, I'd expect a tanking again.
Oh, so you don't think this is sustainable simply because you can't keep essentially just printing money?
Well, it's sustainable in the short term because the money has found an outlet in equities. But if people then it's become a self-fulfilling prophecy. You know, people have gone back, thought the market had overshot, gone back in, good news stories kind of fed through. They've convinced themselves there'll be a recovery, and there's all this money looking for a home, and it's piled in. Eventually, some people say, hang on a minute, what are the underlying fundamentals here? What can we really expect in terms of growth? Have growth prospects in the US increased that much in the wake of COVID to justify these profit expectations? Now, even though I'm an optimist, I'm on the technology front, I'm not an optimist that that technology shift will turn profits around in the next 12, 18 months. It's a more long-term effect. It's not a short-term effect, but that reality isn't reflected in the stock market. They're just pricing in every good piece of news they possibly can, and that is not sustainable. And so, in my view, the market will reverse at some stage in the future.
Okay, well, I won't ask you when, because obviously you're not qualified to provide regulated financial advice, but I found this fascinating. Since we're up against time, just a last couple of questions. We've obviously talked about, the potential impact on conspicuous consumption. Are there, in terms of either geography, UK localities or global regions, or in terms of industries? Let's start with that. There seems to be a lot of consensus that technology is likely to be an enduring winner. From your research, what do you see? Who do you see as the winners and losers in terms of vertical sectors?
Again, I'd hedge it by the assumption of the scenario we're talking about. So what I'm saying is in kind of my middle road U or V scenario, but clearly in worst case scenarios, and even under the kind of more optimistic scenarios, there are significant sectoral shifts underway here. Between sectors, obviously, those still in lockdown and prevented from operating at full capacity, travel, tourism, hospitality, all those sectors are getting crunched. And in some of them, we're going to see very significant changes in the structure of those markets in terms of market concentration. Will Virgin still be here? EasyJet, Ryan, all these companies, we're not quite sure. We know they're going to be back in a smaller form, at least initially. But there's a chance that some of them won't return. So market concentration is going to change as well. And that's going to change in a lot of service sectors. People are talking about, the shift away from offices and online working. That's clearly true. But there are just as probably many companies who actually won't work for as those for it will work for. And so again, we don't want to get too carried away here. And there'll be variations within sectors. There are some where it raises lots of serious mental health issues for their employees. For others, it's just a dream. It's what they've always wanted. And if you've found a new agile way of working, and your workforce is willing, and you've only got 6 months left on your lease on your office, then you're in a position to move. If you're not in that situation because you've got a 15-year lease and a lot of your staff are unhappy, then you're in a much more inflexible position. And so I think it's going to be fascinating here. Not really even sectors, but it's within sectors and even within companies. My sister-in-law is a partner in a law firm, and their trusts and probates went through the roof in the wake of COVID. Certainly, drawing up wills and things like that. But other parts of the country, companies just went through the floor. And I think so one of the key things here is this huge variation.
Absolutely. And can I just ask, since we're up against the hour, one last probably unfair question, which is, from everything you've said, and bearing in mind you just talked about agility and innovation and technology, what, as an economist, would your advice be to the marketing services, professional services, and PR and comms industry to survive and thrive?
Well, I think it's agility. It's taking on board the technology lessons of the crisis. And it's just, we talk a lot of, economists talk a lot about productivity, but probably a better word for the 2020s is agility. And the crisis has revealed those ways in which all companies can be much more agile. And they just need to try, what they need to do is put those insights into action and not just go back to the way things were before, because you can be absolutely sure this is one of those critical junctures in history when life will not be the same tomorrow than yesterday.
Well, that's a wonderful soundbite on which to end. Graeme, thank you so much for your time and insights. I mean, as they say, we could have chatted all day. I found it absolutely fascinating. And I think your closing remarks about agility, that the old ways alone will not work, are a very important and salutary message for all of us in our industry. So again, thank you very much for your time. For those watching live, thank you for your inputs. We've got some thanks coming in from those on the line. And for those watching back, I hope you found it as fascinating as I have. Graeme, thank you, and thanks for joining, and we look forward to welcoming you to the next Task Force Forum next week.